Welcome, everyone. Today we're diving into some of the top Singapore blue chips everyone is watching right now, covering companies that are making big moves in AI, data centers, aviation, transport, and defense.
I'm really excited by this lineup. There's so much depth here. What stands out first for you?
Well, let's start with Singtel. It's priced at about $5.01 and has a PE around 13 times with a 3.6% dividend yield.
Yeah,
The company is shifting its focus toward AI infrastructure and data centers, which is a major pivot from its legacy telecom business.
right. And I noticed they even launched a 250 million US dollars AI growth fund and partnered with Nvidia for an AI lab. That's a pretty bold move.
Exactly. It's like they're trying to harness the secular demand for AI and data centers. But on the flip side, there's the DBS downgrade to hold, citing limited upside after that sharp re-rating. So it's a mixed bag.
That downgrade does give pause, though I can see why 15 out of 17 analysts still rate it as a buy. It's a pivot that might just pay off despite legacy challenges.
Absolutely. Now, shifting gears to Keppel Limited, trading at 11.90 Singapore dollars with a PE of roughly 21 times and a dividend yield around 2.8%. Keppel has been reshaping its business model, moving from an old school marine conglomerate to a global asset manager, especially with its sharp focus on data centers.
And those numbers are impressive. Record net profit of $1.1 billion and a whopping 39% YOY growth. But don't you think the P/E at 21 times might be a bit stretched, given traditional expectations for conglomerates?
Well, that's where the bull versus bear debate really kicks in. The bull sees it as perfectly positioned at the crossroads of AI, clean energy, and urbanization, while the bear worries about overpricing and market conditions.
Right. I mean, it's interesting how they also monetized mature assets by divesting AI-ready hyperscale facilities to the Keppel DCREIT, keeping the cash flow smooth.
Exactly, that move offers a nice balance of growth via infrastructure expansion and stable fee income. It's like they're hedging their bets on both sides.
Let's jump to Singapore Airlines now. They're trading at 6.64 Singapore dollars, with a PE around 18 times and a 5.1% yield, right?
Yes, and there's a lot of momentum there. For instance, their Q3 FY 2025/26 revenue hit a quarterly record of $5.5 billion, and they carried over 10.8 million passengers. But interestingly, net profit fell significantly due to the absence of a one-off gain from the previous year.
So, while revenue and operating profit are showing strong growth, the net profit dip highlights a risk factor as the airline navigates the cyclical nature of its business. Would you say that ruins the dividend story?
Not necessarily, especially when the dividend yield is attractive at 5.1% and fleet modernization with new aircraft deliveries is poised to drive down unit costs. It's a premium yield play that appeals to income investors.
I get that, but the flight industry is notoriously cyclical, and fuel hedging might cap some upside if oil prices drop. There's always that risk of capacity expansion leading to yield compression too.
True, those are the inherent challenges. Now moving on to ComfortDelGro, which is quite the story of international expansion.
Right. Trading at 1.46 Singapore dollars with a PE of about 15 times and a 5.5% dividend yield, it's interesting to see their revenue crossing the 5 billion Singapore dollars mark for the first time. Quite a milestone.
Exactly. And what really makes it stand out is that its overseas revenue now makes up over 55% of total revenue, up from around 49%. They are clearly diversifying away from a traditional taxi fleet.
But then there's the concern about the structural decline in the taxi fleet and the intense competition from players like Grab. How do you see that factoring in?
It's a valid criticism. While the yield remains attractive and international contracts, like the London bus contracts and acquisition of Addison Lee, are showing positive signs, the domestic market remains challenging. The AV, or autonomous vehicle, angle is promising but also carries risk given its unproven scale.
So it's a balancing act, a mix of domestic challenges offset by growth in international and tech-driven ventures.
Right on. Now, let's talk about ST Engineering. Trading at 10.97 Singapore dollars with a higher PE of around 32 times and a modest yield of 1.6%, It's more of a defense and MRO powerhouse.
Wow, a PE of 32 times really stands out. They've been consolidating on the defense and maintenance, repair and overhaul side, right?
Yes, exactly. Their FY 2025 showed record revenue and a substantial increase in operating net profit. They're heavily investing in new contracts, with a record order book valued at 33.2 billion Singapore dollars.
Yeah. I do wonder, though, if that high PE might scare off more conservative income investors, given the execution risk on converting that order book into tangible profits.
That's a fair challenge. While the bullish argument is that global defense spending is structurally up, the bear side highlights that modest dividend of 1.6% might not satisfy income-focused investors. It really depends on whether one is bullish on the long-term defense cycle.
Absolutely. It's all about the risk profile. And what's fascinating is how these five stocks represent a cross-section of Singapore's economy, from AI transitions to transport and defense.
Exactly. Singtel is in the AI and data center game. Keppel is capitalizing on the digital infrastructure boom. SIA continues to leverage its brand in a recovering travel industry. ComfortDelGro is transforming itself globally. And ST Engineering stands as a giant in defense and MRO.
It's like each one is a microcosm of a different strategic narrative in the market. But don't you think the discussion becomes a bit too segmented? How should an investor approach such a diverse set?
I believe investors often need to balance growth and income and diversify across these narratives. Singtel offers both growth and income. SIA and ComfortDelGro cater to high yield, while Keppel and ST Engineering deliver robust earnings momentum.
Yeah, it sounds like there's no one-size-fits-all play. The risk appetite and portfolio strategy will really dictate which of these blue chips an investor might lean towards.
Absolutely, and it really underscores the importance of due diligence. Even though these stocks are in the blue chip category, each has its unique challenges, be it valuation risks, cyclical sensitivities, or implementation uncertainty on new business lines.
Speaking of due diligence, how do you feel about looking at REITs in the context of Singapore investing, particularly since they were mentioned as a complement here?
That's a great point. Some investors might pivot to REITs for stability. There's a guide out there on the best SREITs in Singapore this year, which can nicely bundle with these blue chips for a well-rounded portfolio.
Yeah, especially since the dividend yields from companies like ComfortDelGro and SIA are enticing for income-focused investors. The combination of asset-backed yields with growth is compelling.
Exactly. It's like having a two-pronged strategy. Enjoy steady income and capture growth in sectors undergoing technological transformation and global expansion.
I have to say though, I'm a bit cautious about the pace at which these companies, especially Singtel and ComfortDelGro, are transitioning. Legacy business models are hard to overhaul quickly.
I agree. And that's where the debate really intensifies. Singtel, for example, has a strong dividend, but its legacy telecom revenues are flat, so the AI and data center shift has to be rapid enough to compensate. Similarly, ComfortDelGro faces a structural decline in some segments even as it expands globally.
Right. And with ST Engineering, the defense sector's inherent risks, like potential geopolitical shifts, could also impact its long-term stability despite the impressive order book.
Yep, it's a nuanced picture. Ultimately, it all comes down to aligning these opportunities with your investment goals, whether it's steady income or aggressive growth.
Exactly. This conversation really highlights how Singapore's economic landscape is diversifying. There's innovation underpinned by traditional strength across these blue chips.
Absolutely. And it's exciting to see a market where companies are reinventing themselves. From AI infrastructure in Singtel to the evolution in Keppel to modernizing flight and transport with SIA and ComfortDelGro, and finally, ST Engineering driving defense innovation. Each has a compelling story.
Yeah, it's a dynamic mix. And just for our listeners, always remember, do your own research because these insights vanish quickly in today's fast-paced markets.
Right, and whether you lean towards the consistent yields or the promise of future growth, it's crucial to keep an eye on the market fundamentals and be aware of the bull and bear cases. Thanks for the
Absolutely.
engaging discussion today. It's been a real deep dive into Singapore's blue chips.
For sure. Thanks for the insights. Until next time, keep watching the market and making informed decisions.